Hi everybody, you understand what a commercial bank is and how it's different to an investment bank. You know the core functions of a commercial bank. Let's in this video really dig down into the operations of a commercial bank by understanding the balance sheet of a commercial bank. First, what is a balance sheet? Well, a balance sheet is a financial record of all the assets, liabilities and capital, where capital comprises of shareholders' equity at any given point in time. Remind yourselves, what are assets? Assets is anything of value that the commercial bank owns. Alright, so anything of value that can be converted into cash owned by the commercial bank. That's a good way to learn it. Liabilities is anything that the commercial bank owes. Alright, so something that is owed to somebody else. So deposits, for example, they are owed to individual savers. They do not belong to the commercial bank. Any borrowing that the commercial bank does is owed to the lender. But also capital. Capital is a section within the liabilities component of the balance sheet, and it comprises of two key parts: shareholders' funds and retained profit, also known as reserves. These two things do not belong to the commercial bank. They belong to shareholders. Clearly, shareholders can take their funds out whenever they want. Retained profit, shareholders get that in the form of dividends. Alright, so capital is the shareholders' equity part of the balance sheet, comprising of these two different components. They are liabilities because the commercial bank owes them to shareholders. They do not own those two things. But it's a separate little section in the liabilities part of the balance sheet there. The balance sheet is so useful. It gives so much information to the managers of the commercial bank, very important, to shareholders themselves, because shareholders can see how their funds are being used to make assets, which hopefully will make profit, right? So important for shareholders to see it, important for shareholders, important for government, important for the Bank of England and the other regulators as well to see the balance sheet as well, because it gives information about liquidity, right? And therefore information about potential bank run, potential liquidity crisis or not. It gives information about potential insolvency, whether too much risk is being taken, too many long-term assets are being held, when there isn't enough capital, right? All stuff we're going to consider later. But basically it gives an idea of the health of the commercial bank too, and those stakeholders will want to look at the balance sheet to see whether the commercial bank is healthy, both in terms of liquidity, both in terms of capital compared to loans that's being issued by the commercial bank. So very important record this balance sheet is here for so many different stakeholders. The balance sheet is not called a balance sheet for nothing. It must balance according to this equation. Assets must equal liabilities plus capital. We know that capital is a part of liabilities. They are liabilities themselves, these two things. So you can think of it as just assets equaling liabilities. And that makes total sense. Because if liabilities is more than assets, it means what the bank owes is more than what the bank owns. And that's not a sustainable position at all. That is how a bank can fail. So assets must equal liabilities plus capital. Let's look down and see in more detail what assets and liabilities there will be on a commercial bank's balance sheet. Well, if we look at assets, I've written them down here, the major assets in order of liquidity. We've got cash, the most liquid asset, notes and coins that the commercial bank will have. Reserves at the Bank of England. Remember from my previous videos I said how all commercial banks in the UK, for example, will have a bank account at the Bank of England, whereby when deposits are put into the commercial bank, a fraction of those will be kept at the Bank of England in the commercial bank's bank account and earning interest there. That can be called upon at any time. If depositors come back and they want their money back at any time, the commercial bank can take that money from their bank account at the Bank of England and fulfill the needs of its depositors. So it's very short-term liquidity here, very short-term asset, hence it's number 2 in the list. Money are called at short notice, that's a bit of jargon there. This is any interbank lending that the commercial bank takes part in. Again, the commercial bank can get that money back at any time they want, often daily or overnight. Very short-term liquidity, a very short-term asset. Short-term investments, so if the commercial bank is holding short-term government bonds or short-term corporate bonds. Long-term investments, if they're holding any long-term government bonds, long-term corporate bonds, or any shares, that will be recorded as long-term investments. Advances, a bit of jargon here. This is a key part of commercial bank operations. Advances, so issuing mortgages, for example, issuing loans for entrepreneurs who want to kickstart their business, offering loans to firms who want to invest, offering loans to individuals who want to buy a car, right? All the loans that commercial banks will issue, a key part of their operations, advances. And fixed assets, these are very illiquid. Illiquid, think of things like property, think of things like machinery, very hard to convert into cash, right? And same with advances, because they are longer term, mortgages for example, loans for firms to invest, they're longer term, you can't call on that money back straight away. So illiquid and fixed assets, the most illiquid asset. The liabilities, deposits that individual savers have put in the commercial bank, or maybe firms that have put in the commercial bank, clearly the commercial bank owes that money to its depositors. Very, very short-term liability, because depositors can come back whenever they want. The commercial bank has got to pay that money back straight away. Short-term borrowing, so if the commercial bank decides to borrow from the interbank market or borrow from the Bank of England, these are short-term money market transactions, short-term borrowing there. Long-term borrowing, so if the commercial bank decides to issue corporate bonds to raise finance or issue shares to raise finance, that would be in the long-term borrowing section here. And then you've got the capital part of the liability section, which comprises of shareholders' funds and retained profit, also known as reserves. The commercial bank is liable here to shareholders. This is shareholders' money here. Alright, so you've got that section, a key section of the liabilities part of a balance sheet. As we said, assets must equal liabilities. So when we add up our two sections here, they must be equal to each other for the balance sheet to be balanced. Stay tuned for my next video, guys, where we look at different scenarios and how those scenarios will be recorded in the balance sheet. Very useful for you to watch that video to gain confidence of how exactly this balance sheet works and for the importance of the balance sheet. I'll see you in that video.